the Doc and Eric Dubin, along with special guest host Turd Ferguson of TFMetalsReport.com, joining us for the SD Weekly Metals and Markets Review. Thanks for joining us today, Turd.
Hey, my pleasure, Doc.
Well, it's been another crazy week in the markets. Bernanke is speaking today this morning, and once again, the metals were tanked when Bernanke spoke, but almost surprisingly, both gold and silver recovered strongly off of the lows, what Turd would call an FUBM. Pretty strong recovery into the close today. So, Turd, what's your take on really the week's action in gold and silver?
Well, I think on most part it was constructive, Doc. In that we weren't down. I didn't have this a horrible, terrible week. We were down a little bit, but I think the last 24 hours were particularly instructive in that maybe a half hour after the COMEX closed yesterday, there were suddenly these rumors going around that were obviously planted, that there was soon going to be a John Hilsenrath story, kind of previewing Bernanke's speech in Chicago today, and speculating that there was going to be some announcement of a QE tapering and all this kind of stuff. And of course, that all happens after the COMEX is closed, and the COMEX gets, or the Globex, the after hours markets gets carpet bombed for about $20, and we're all pulling our hair out. And then of course that then accelerated all the way into the COMEX open today, to the point where between the point where the COMEX closed on Thursday and reopened today, gold was down something like $40 on a meaningless, baseless rumor. And so, yeah, it's nice that prices came back some, but I don't know. We all talk about the events of the last month being an act of desperation. Well, yeah, maybe. I mean, you get something like this where the market is jammed down purposefully on what turns out to be a nonsensical rumor, and then it reverses. Well, makes you wonder.
But it also comes in the context of Bernanke speaking, and then you got this goofy G7 meeting that nobody's supposed to talk about, and the G20 meeting, and so forth. So whenever the algo traders setting up their programs or the momentum guys at hedge funds look for catalytic rumors, such as this goofy thing that apparently came from a Twitter account of Andrew Yorks, who's a portfolio manager, at least according to one of the Tylers over at Zero Hedge. You have the market primed and ready because everybody expects the cartel to beat the blood out of the market, gold and silver, anytime that Bernanke and company and G7 meetings are on the docket. And here we are. That's exactly what happened. Silver closed almost unchanged for the whole week, and gold bounced back really strongly. The equities pulled back, or rather rebounded as well, which is pretty telling. So all told, Doc, it looks like this was basically a wash, and it's more expending of the cartel firepower to keep the status quo going. And the longer that continues, the harder they're going to find it to be able to maintain that status quo. I look at this as something that's a positive, even though it wouldn't appear to be so if you were looking at it on Thursday evening.
It'll be interesting to see what type of physical buying this invokes going into next week if they continue to press the pedal to the gas. Because really the physical buying has dropped off quite a bit this week from last week. Premiums are starting to come down on the physical side in silver. The delays are easing up a little bit on the wholesale side. Whereas about a week ago, we were looking at an 8 to 12 week wholesale delay on Silver Eagles. That's now down to about 4 weeks. So you're looking at about the first week of June. Bullion dealers are waiting for their allocation from the mint. Maples is about the same. It's about a 4-week delay. 100-ounce bars tightened up, or eased up a little bit, I should say, to it's only about a 3-week delay now. And almost most surprisingly, some of the largest U.S. wholesalers now have 90% silver in stock. At SD Bullion, we have some in stock, really for the first time in, I'd say, 3 or 4 weeks. We have some in stock now sitting in the shelves that not going out the door for the instant we receive the inventories. And premiums on Eagles and Maples on the wholesale level are coming down slightly. We were able to drop premiums on those, both of those, about $1 today at SD Bullion. So it'll be interesting to see with the weeks to come here, going into next week, whether The cartel tries to keep gold headed towards 1420 and below, and whether they try to induce a retest of 22, because that really will bring the shortage situation right back to a head.
I got a question, Doc, about the change in the allocation with the 14 some odd primary dealers for Silver Eagles. If we went from 8 to 10 weeks to what was it, 4 weeks, and just a single week of time. That seems rather unusual. Do you think that that's something that speaks to the Mint increasing its availability of Silver Eagles, or maybe canceled orders, or a combination of both? What do you think caused that pretty significant change?
Question, Eric. For the wholesale side, it's most likely the Mint has actually increased their allocation to the dealers, meaning that they're going to be receiving larger allocations in the month ahead, so they're able to go ahead and sell a further amount. There's really from the wholesale side, there's really not much such thing as a canceled order, or you're pretty much done doing business with those wholesalers. So now on the retail side, that's a much bigger issue, especially after a big smash like that. It's a pretty big headache for the bullion dealers, something that a lot of people don't think about, but a lot of people that make a purchase, say in the day or 2 days or 2 or 3 days before a big cartel smash. Unfortunately, a lot of people think that they don't need to live up to the purchase contract that they made prior to that. But on a wholesale side, when you're dealing with dealers, they don't have very many canceled orders unless the bullion dealer is going out of business. It's really the only reasonable explanation is that the Mint has increased their allocation somewhat to the 12 primary dealers.
That's amazing.
Right, definitely somewhat of a surprise. We weren't really anticipating. We were anticipating, especially in the generic rounds, private Mint stuff to start to come down first. We weren't really anticipating the extreme time delay on the Mint products like the ASC to tighten up that much in a week.
Right.
But I guess, Turd, wanted to talk to you about now, while we're talking about the physical. I know over at TF Metals Report, you've been spending a lot of time focusing over the last couple weeks on the GLD drawdown. And I think since the February high, GLD's down over 10 million ounces of gold, so just a massive amount. There's been really nonstop liquidations until yesterday's first edition in really what seems like months. And that edition on Thursday was pretty much all taken back out today here on Friday. And there's really been a lot of speculation that all the physical gold being freed up from GLD is heading east, particularly with China importing something like it was over 220 tons of gold from Hong Kong just in March alone. It was nearly double the previous record for gold imports in a single month. So I know you've been keeping a close eye on the GLD withdrawals, TF. So what's your take on the GLD inventory drawdown?
Well, it's been going on all year, and it is such an interesting phenomenon to see it happen, and it makes you wonder about the gold in the first place, and then obviously additionally where it's going. We're now down about 300 metric tons year to date, and we're here on May the 10th. Interestingly, the first 100 metric tons came out in a little over a month. I think we were down at about March the 7th is when we hit the first 100 metric tons. The next 100 metric tons came out in about 6 weeks, from March the 8th to about the middle of April. And now the third 100 metric tons came out in the last 3 weeks. Now, maybe that's a little bit indicative of what you guys were just talking about on the kind of retail level and demand. And so maybe that trend will peak here. But more significantly, it gets back to, and what my main concern is the amount to which that gold is, I guess we'll say, encumbered or hypothecated, or whose gold is that in the first place? We've got where did that gold come from that is sourced to the GLD and the GLD's vaults? I mean, a lot of it came from central banks. It comes from bullion banks. Well, where do they get their gold? Where do the bullion banks get their gold? Well, it's on deposit, and someone has a slip for some registered gold, and then the bank then borrows it and puts it in the GLD. And so then when someone then redeems that gold and it's shipped out to cover a supply shortage someplace else, be it China or anywhere, the original person who had their gold on deposit at that LBMA bank or wherever still thinks they own it too. And so that's where this is all really going to catch up with the banks. And that's what I think most people kind of have their hair on fire about in watching this gold come out, is we know that it's all kind of a shell game to begin with about hypothecation and rehypothecation and allocated, unallocated, registered and eligible and everything else. And the drawdown in gold is something that makes you feel like the entire house of cards is starting to crumble, and that's why we're keeping a good close eye on it, that's for sure.
One other thing, Turd, in the midst of this morning's big takedown of the metals while Bernanke was speaking, reports from Andrew Maguire of massive physical gold purchases.
Well, and that's right. It's as you know, there are no official statistics that come out of the LBMA every day. But a guy like Andy has been trading in London for 30 years, and so he's got contacts at every wholesale shop, every desk, and so he's able just to call around to his trusted friends that he's known for years and come up with his own estimates of how much gold is actually allocated and delivered on a daily basis. A regular busy day is somewhere between 10 and 20 metric tons, but I was texting back and forth with Andy this morning, and he said, this is going to be the biggest day of the month by far. And then I just saw this afternoon, he was on Eric King's site saying he had a number coming pretty close to 40 metric tons allocated just and delivered just today in London. Again, now that's indicative of a pretty strong demand at these prices, and it's also a reason, I'm sure, why, besides the removal of the rumor and worry about Bernanke and everything else, it's an actual fundamental reason why prices recovered during the day on the COMEX, because at some point, whenever you get that type of physical demand, the banks actually have to get on the bid to hedge themselves. So it translated back into higher prices today. And, you were mentioning earlier, what will we see next week? Will we see that trickle down? Yeah, we'll probably see that trickle down too into next week too. So hopefully we'll have ourselves a little better next week in gold than we had this.
And a drawdown in gold is only about maybe 1/2 to even 1/3 of the size of the physical gold being vacuumed up by China and Russia and South Korea and all of the other countries that are accumulating like mad now. I mean, I was just working on some of the numbers today, and it's just mind-boggling. I would not be surprised if when April's numbers for Hong Kong's import window is reported, that we get almost darn close to 500 metric tons.
Yeah.
I mean, it's way over 300 metric tons. Doc just mentioned the 223 metric tons measure for March's report in Hong Kong, and we know that the majority of that gold flows to the jewelry refiners, and at least 50% of it goes to the consumer in China, and their whole wholesale distribution chain was blown out in April. It was completely emptied. They had to order about 4 times their normal order rate from the previous year-over-year comparison. So when you look at all of those numbers, I mean, we're just, I suspect that people are going to have their jaws drop when Hong Kong's next figure gets reported.
And I would add to that too, Eric, the what we've seen happening out of Shanghai. The Shanghai Metals Exchange, they publish their delivery numbers every day, and through about the 1st of May, the cumulative total for the year was a little north of 1,000 metric tons. And now suddenly it has just stopped. Every day we have people go back and say, well, I wonder if they deliver it. And they're delivering some silver, a couple of tons of silver a day, but hardly any gold. And that's a real head scratcher. And we'll see what that means, if they're waiting to get their supplies replenished. I can't imagine their demand has just suddenly disappeared, that's for sure.
Well, with the Shanghai market, part of the lumpiness in data could, in fact, be explained by Bank of China purchases. So, if they get a big order and they take off a lot, and all of a sudden they're quiet for a while, it could be just the fact that
could be that too, you're right.
Ongoing. I mean, just idle speculation. I have nothing to base that on, but...
No, but I think that's a good point.
Yeah, we'll see. But the bottom line is that the numbers that are coming out in terms of offtake of all of these stashes, be it the COMEX warehouse supply, be it what's going on in CLD or JP Morgan's vault, wherever the media pays attention to, the bigger story is actually in the reality of the physical offtake, and it's just mind-boggling how much gold is being hoovered up all over the world and being sequestered away to never be seen in the markets for decades to come, most likely. And China, in fact, is warehousing as much as they appear to be warehousing. That all augurs for very limited period of correction in this ongoing bull market, as opposed to the death of the bull market, which is the primary thesis that we have to endure anytime we pick up the remote control and flip on the Bloomberg, etc. I continue to believe that we're going to have a pretty interesting summer, that the prices will be relatively firm, worst case, if not surprising to the upside.
I'd like to discuss a little bit here about the COT report, and really over the last 6 months, and whether the commercials really are distancing themselves from JP Morgan and really leaving JP Morgan as the only big paper short. Regular listeners are aware, Eric's been saying for quite a few weeks here, that silver really doesn't need to be taken below 20 or 18 for JP Morgan to extricate themselves from
22 even.
Right, even below 22 even, to extricate themselves from their massive short position. They just need they would be able to really with a range trade in the 22, 23 to 25 area over a few weeks. So I wanted to start with Turd. We were chatting before the radio show began about some of the things you've noticed about the changes in the structure of the commercials and the COT over the last, really say, 4 to 6 months.
Yeah, I trace all of this back to early September of last year, and as that was the real game changer, because at the FOMC meeting that concluded on the 13th of September, that was when we got the Fed lines, as we call them, that said that Operation Twist was going to end, and that the Fed was, when that ended, they were going to have to just start directly monetizing at $45 billion a month, and that they were going to do $40 billion on top of that of mortgage-backed securities purchases. So that was the game-changing moment. And at that particular moment in time, the metals had been rallying for about 4 weeks, and the banks had been shorting into it, providing the paper. And I guess for lack of a better term, they were caught with their pants down. And so we sit and we look back now, and the 8 months that have taken place since, and everybody's just scratching their heads going, how could the metals have gone down so far in the face of these overwhelming fundamentals? And I would suggest that it's all been rigged that way by the banks so that they could extricate themselves from these enormous short positions that they'd built up. And once they are able to extricate themselves to as much as they can, then the fundamentals will take back over. For example, if you go back to the Commitment of Treasury Report survey that was taken 2 days before that FOMC meeting concluded on the 11th of September, the gold cartel, the gold commercials, had a net short position of 737 metric tons of paper gold. Where if they were forced to deliver, that's a lot. As of last Tuesday, they had trimmed that baby by over 63% down to 272 metric tons. So all the while the gold bull market is allegedly ending, and we're all supposed to be headed for the hills, all of us dummies, the gold banks, those really in the know, the gold banks, the ones that always end up winning, have reduced their net position by over 250,000 contracts, or 150,000 contracts, an incredible amount. And in silver, it's even more dramatic. The silver commercials back then in September, right before QE to infinity was announced, they were net short 47,000 contracts. You do the math on that, it's about 236,000 troy ounces, 30% of global silver production, mine production for 2012. That's how much they were short. And now, as of today, the commercials are short only 14,500 contracts. They've trimmed that position by almost 70%. And Doc, finally, the strangest little component of all that data that I just laid out for you is in the silver commercial category, where we all look at JP Morgan when we expect them to, maybe one day no longer be naked short and all this kind of stuff. And there's always this discussion about, maybe they're long someplace else and how would we ever know and all that kind of stuff. Well, in the data that we get from the CFTC, though, chew on this. Back on September the 11th, 2012, the commercials, the banks, the large traders, that whatever, in silver were long 32,206 contracts. It's historically about the amount that they that they, between 30 and 40,000. Anyway, back then they were long 32,000. Today they are long almost 66,000 contracts. So this whole time when silver's been going down against the fundamentals and down $13 or $14 since September, the banks have doubled, more than doubled their gross long position. The short position's about the same, but hardly changed at all, from 79.5 to a little over 80,000. What has really changed is the specs have gone short, and by doing that, the bank longs have doubled. Which side do you want to be on? I mean, anybody can see this. I mean, you want to be on the side of the banks. They know what they're doing. They're getting ready to let the metals run, and they're positioning themselves for when the fundamentals finally take over. No question about it.
Yeah, I find that argument very compelling, and just also to remind some of the readers who aren't looking at the chart in front of them, and while we're having this conversation, bear in mind that around the September 11th period or so, that was around $35 silver. So that was a peak, and you had RSI measures pushing up towards 90, and there was quite a bit of a head on the market as everybody's expecting QE to infinity to just take everything higher, and then voila, the capping effort went on in earnest. But hey, even if this isn't a complete switch where we have the best described James Sinclair thesis of the bullion banks flipping over net long and remaining as such as time goes forward, in the very least, it argues for a return to some sensible price in the mid 30s or 28 to 32 or so, just so that the short positions can be covered and they can benefit to some extent from the longs that they've been adding as we've been declining. So the smart money is speaking, and they're in fact positioning for higher prices. So what does that tell us?
Yep.
So we have really the GLD inventories, we have the banks' long positions, physical demand really across the world, especially in the East, though, in Asia, all really screaming higher prices to come over the intermediate to long term for gold and silver. U.S. demand down a bit this week, but still at setting record levels for the year for 2013. So it should be a pretty interesting summer. I think all three of us are in agreement that the metals have likely bottomed, particularly on the physical side. So it should be an exciting summer. For all our listeners, I just wanted to thank you for tuning in, and a special thanks for Turd for joining us here tonight. I know that both Eric and myself are regular readers of TF Metals Report. If any of our listeners haven't checked out his site, highly recommend it. It's a daily read for both of us. We're both Turdites, Turd, so thanks for joining us, and
we want one of those hats.
Yeah, we want a hat.
I gotta ship a couple to you guys. You betcha. We'll get it done.
All right. So for all our listeners, thanks for joining us for the SD Weekly Metals and Markets.
SD Bullion.